the EP ratio and the Treasury bond yield. The price to earnings ratio and the Treasury bond yield relate to each other in the following ways. Earnings yield decreases as PE ratios increase. This brings the earnings yield closer to bond yields. If the earnings yield on stocks is less than the yield on Treasury bonds, this is known as the bond equity earnings yield ratio, or BEER, being greater than 1. When this happens, investors may reinvest the proceeds from selling stocks into bonds, which can decrease the PE ratio and increase the earnings yield. Here's some other things to know about PE ratios and Treasury bond yields. PE ratio. The PE ratio is calculated by dividing a company's share price by its earnings per share. This ratio shows how much the market is willing to pay for each dollar of earnings. Treasury bond yield. The yield on a bond is the return an investor receives on their investment. The price and yield of a bond have an inverse relationship, meaning that as the price of a bond increases, its yield decreases. Treasury bond interest rates. When a Treasury bond is issued, the coupon rate remains fixed for the life of the bond. However, the bond's price can change as it's traded in the market. When the S&P 500's earning yield is higher than the 10-year Treasury yield, the market is considered bullish. This means that the companies in the S&P 500 are generating relatively high earnings compared to the returns from a 10-year government bond. A bullish market indicates that stock prices are likely to increase, making it a good time to buy shares. The earnings yield is a metric that money managers use to compare the earnings of a broad market index to prevailing interest rates. When the earnings yield is lower than the 10-year Treasury yield, the market is considered bearish, which means that companies are not generating relatively high earnings compared to the 10-year bond yield. A bearish market suggests that stock prices will decline. Other factors that affect the market include interest rates. When interest rates rise, businesses and consumers tend to cut back on spending, which can cause earnings to fall and stock prices to drop. Bond prices. When confidence is low, bond prices rise and yields fall. Time to maturity. The longer the time to maturity on a Treasury bond, the higher the yield. The Fed model is a market timing tool that determines if the U.S. stock market is fairly valued by comparing the earnings yield of the S&P 500 to the yield of 10-year U.S. Treasury bonds.